And joining us now is DataTrek Research co-founder Nick Colas and Wilmington Trust head of investment strategy Meghan Shue. Welcome, guys. So, Nick, in the morning, we get Home Depot's report before the bell. It's the second highest earnings weighting in the S&P, behind Amazon. I learned that thanks to CNBC's Robert Hum. So how important is the Home Depot guide and the size and nature of the pro backlog, not just to that company, but maybe to the S&P overall at this stage, you think?
I think it's very important because the consumer is still holding up the U.S. economy, and we want to see Home Depot and the other retailers reporting continue to reflect some optimism that the consumer is still in the game. They've had a lot of challenges in the last year between the drawdown in the S&P and a lot of inflation. So we want to see the consumer still spending, and Home Depot is going to be an important tell for that.
Yeah, and the consumer part of their business had been having trouble as it was, so we'll look closely at that. Now, Meghan, when it comes to equities overall, you said a month ago you were underweight equities, slightly overweight tech and communication services. That last part hasn't really gone your way so far. So are you doubling down or changing direction?
Well, as we look at it, I think a few things have changed probably since we last spoke. We were expecting with a greater than 50% probability of a recession at the end of this year or beginning of next year. And we've since taken down our recession risk to roughly 50-50, maybe slightly in favor of a soft landing. So the economic outlook has certainly improved. Inflation coming down and the consumer remaining resilient is a key part of that. But as we look at our overall risk weighting, we are not yet leaning back into risk, mostly because the risk reward of equities just looks still very unattractive. And we have now the market, I would say, more than pricing in a soft landing. So has gotten borderline euphoric by some measures. And we're probably going to enter this churn period here. Now, we've certainly seen growth and tech stocks come off a little bit and a nice surge in value over the last month or so. But I would say long term, those parts of the tech market and communication services still look attractive to us. I think the artificial intelligence story is still there. I think it's going to be very transformative over the next 5 years. I'd be a little bit more cautious here on some of the more consumer sensitive areas of the market.
Yeah, we keep talking about soft landing, Nick. And we know the equity market is pricing that in, and it's a key narrative right now. But what's the bond market telling us?
Yeah, the bond market's telling us not a great story because it's worried both about a rising inflation because we haven't had a recession, which is what pulled inflation down over time. And real rates are rising as well, which is perhaps even more troubling. If you look at where real rates were even just a few months ago, back in April, they were low 1%. Now they're high 1%. That's pushing overall yields higher, and it's going to continue to do so. We're pretty bearish on bonds until we see a 10-year that's more like 5% than where it currently is. Because real rates are rising, we have a lot of issuance coming up. And when you layer that all together, I think it feeds into that narrative that perhaps we've got to wait for the equity market to catch up with reality for a few months before we get that final end of year rally that we usually get. So tough times for the next few months. Yeah, Meghan, I want to get your thoughts on this and what all of it means for how you position yourself across markets more broadly right now.
Yeah, I would agree with that. I think that the focus is probably going to start to shift maybe a little bit away from inflation towards interest rates and specifically real rates and what that means to consumer credit, because that's where we're starting to see maybe the starts of some potential cracks, and it's still early. But if you look at consumer credit card delinquencies and things of that nature, they're kind of falling into the same category as a lot of other data, which is deteriorating at an alarming rate, but still not yet back to pre-pandemic levels. So we're watching those things closely. I would say energy and yields are interesting because they're increasing probably in good part because of increase in demand and growth expectations. We have Atlanta Fed's GDP now forecast above 4% for the third quarter, which is really remarkable given where we started the year. But those could start to bite if they continue. Right.
Now, finally, Nick, Meghan said equities are looking a bit euphoric. She sounds skeptical, but in the medium term, you know, after Q3 is done, and that's just a few weeks out, you sound pretty bullish. You think Q4 is going to be strong for stocks?
Yes, absolutely. I mean, if we look at the next 50 days, definitely tough times, but we still have the fundamentals of a good bull market going with us. We still have investors focused on corporate earnings rather than macro risks. We still have looking forward to the Fed cutting rates next year. The classic lineup, the classic setup for a bull market is absolutely still in place. We just have to live through the next 50 to 60 days until we start seeing Q3 earnings and that end of year rally. So longer term, definitely bullish. Short term, it's going to be tough.